Good afternoon, ladies and gentlemen. Welcome to Market Guru, our top show where you get to meet the finest brains on Dalal Street, individuals and professionals who've made tons of monies in bull markets, bear markets, volatile times, as also times such as now. It's my pleasure to host Mr. Aditya Khemka. He's a very well-known expert on the pharma space. He at the moment manages a 550 crore rupee portfolio primarily in the pharma and the diagnostic space at InCred Asset Management. Mr. Khemka has previously worked with DSP BlackRock and has a very strong niche in picking up quality stocks. Earlier, Mr. Khemka was with Nomura, Ambit and Antique Stockbroking. All three are top names in the world of Dalal Street. A very warm welcome to you, Aditya ji. And what a fantastic performance your pharma fund has come up with, the details of which will be shortly visible on the screen. But first and foremost, what is riding this pharma bull? The earlier rally that we saw was somewhere in the COVID space about 5 years ago, but the bulls are back and prancing on the pharma sector. What looks good?
So there are 2-3 things which has contributed to this, Shailesh bhai. First of all, thanks for having me on the show. It's a delight. Now coming to what is helping the entire pharma healthcare space, you have to basically look at 2-3 different elements. First element being the non-performance of discretionary consumption bucket. So, as for different fund managers, when you look to buy stocks or bet on sectors, you want to buy stocks in sectors which have earning growth visibility. What has happened since COVID is that the discretionary bucket of consumption is not really doing very well. And that reflects in, the stock prices of banks, NBFCs, MFIs, auto companies, FMCG companies, even IT stocks. And that tells you that, discretionary consumption is essentially not picking up. Hence, the majority of the fund managers who manage diversified funds, like I also do, they are not finding enough value to deploy capital in discretionary consumption. That by default pushes them towards the pharma healthcare space where consumption isn't really discretionary, it's non-discretionary. So the amount of fund flow looking at this kind of sector is obviously gone up, and that is resulting in some re-rating, some appreciation of stocks as you see in the past 2 years. So that's factor one. Factor two is, the quality of the businesses that we are able to identify. And even within pharma, pharma healthcare people tend to sort of look at it in one bucket. We don't look at it as one bucket. It is actually 4-5 buckets for us. And when we sort of drill down to hospitals, diagnostics, unbranded generics, branded generics, API, CDMO, what we see is that there is a lot of value to be discovered in the branded generic API, CDMO, hospital and diagnostic buckets, not so much in the unbranded bucket. The unbranded bucket seems to be fairly, in fact, maybe even overvalued as you speak. So that's the second factor where, what is driving the returns in the space is not really the unbranded side. It is the healthcare services and the ancillary services, which is driving the value in this space, as you can see as a part of our holdings in the portfolio. Last but not the least, what is also driving the returns in the sector is the excellent performance of these companies that we have been able to choose. Now, why that happening is broadly because the country itself is spending more on healthcare than it used to.
Yes. Okay. With this broad background in mind, Aditya ji, please allow me to explain the portfolio that you manage to our viewers. Essentially, it's a very concentrated portfolio of about 12-13 pharma companies that includes primarily hospital chains such as Aster DM, such as Metropolis, HCG, which is healthcare, is the HCG, which is the top pick at about 19.7% weight in the portfolio. Healthcare Global Enterprises is the top pick. So overall, you will see diagnostics and hospitals accounting for about 51% of AUM, and of course you have a preponderance of small cap companies, which is 80% of the portfolio. It's essentially buying nimble companies where you have the potential of outsized returns, a good profit and sales growth, as also steady cash flows and pricing power. Against this background, Aditya ji, I would like you to explain to our viewers, hospital stocks, record highs across the board, whether it's Apollo, whether it's Narayan Hridayalaya, Medanta, the bigger ones, and especially the ones that you have in your portfolio, all of them near record highs, 52-week highs. Is there a case for government intervention in this space? The average revenue per operating bed is rocketing over the last 13 quarters. Are you a bit concerned?
No, not really. Look, two things. First of all, the hospital business one has to understand. It's the only business where the seller dictates everything to the buyer. What to buy, how much you buy, when to come back to buy. There is no other business in the world where seller has this kind of bargaining power against the buyer. So from an investor standpoint, that's a great business to invest in because you will always have pricing power. The second element for why hospital stocks, have done well is, as you said, the RPOB improvement. But the RPOB improvement is not necessarily pricing. I think people mistake RPOB for pricing. The RPOB improvement comes from 3-4 corners, one of which is pricing. The other is reduction in ALOS, average length of stay. The third is the case mix. So if a hospital earlier used to do only maternity and now does cardiac plus maternity, the hospital's RPOB will go up without any change in pricing of his maternity services. So is medical inflation high? No. Medical inflation isn't actually very high in our country. We are actually, if you look at it, we are the cheapest healthcare provider in the world. We get medical tourists from Northern Africa, from Pakistan, from Sri Lanka, from Dubai. So we get medical tourists from all corners of the world because we are higher quality and lower cost compared to any other country in the world. So I don't see a case for pricing regulation here because we are already the cheapest. Add to that the fact that India has only 0.5 beds per thousand population compared to the global average of 2.7 beds per thousand population. That means even if the Indian hospital capacity quadrupled in the next 2 years, then also we'll be underpenetrated.
Mr. Khemka, there is absolutely no doubt in the investment thesis that you put together. We have quality available at price. More importantly, we see hospital chains now going to tier 3, tier 4 cities, buying up smaller hospitals and maybe using their brand as a leverage to get in customers. Any hospital that you go to in North India is full of people and patients. How long do you see this Goldilocks scenario running within the hospital chain? You have, I think, healthcare, you have Aster DM, Metropolis Healthcare, and I think these are the 3 major hospital chains that you have. And you have eschewed from the big ones. Any reasons why you don't like maybe Narayan Hridayalaya, maybe Apollo, maybe Max Health?
So, Sailesh, at any point in time, what stocks we buy is a function of the risk reward that the stock offers at that given price. So, be it an Apollo, be it a Max Healthcare, or be it an Narayan Hridayalaya, they are all good businesses. They will also continue to grow. But the risk reward that those stocks offer us may not be as good as what we own in terms of HCG and Aster DM. I'll correct you here a little. Metropolis is a diagnostic company, not a hospital stock. So, we own HCG and Aster in the hospital space, both of which we believe have better risk rewards compared to, let's say, an Apollo or a Max or a Otis, which is why we hold these 2 stocks.
Okay. Coming back to the pharma business, you've again chosen small caps like FDCs there. There is Vimta Laboratories doing phenomenally well. We'll just see the stock prices that will be on the screens as yes. So basically, what's the theme? Branded generics, APIs, CDMOs. What's driving your thought process behind these picks?
So let's talk branded generics first, right? The FDCs of the world is like a branded generic company. See, the branded generic companies primarily focus on India and other emerging markets, which are branded generic markets. And in branded generic markets, over the past, what we have observed is that these pharmaceutical companies have a lot of pricing power. So they are able to pass on the escalation in manufacturing cost or operating cost to the consumer because they have an established brand of their product. And because you have an established brand, you are able to take price increases which offset the impact of inflation on your profitability. The same thing we are not able to see in, let's say, unbranded generic players. So in unbranded generic players like, let's say, the Lupins or the Aurobindo Pharmas or the Cadilas of the world, we don't see similar sort of ability to pass on price inflation and cost. Hence, branded generic players over long periods of time tend to outperform unbranded generic players because they have pricing power and unbranded guys do not. Now, why specifically FDC or something? It's very simple. We look at the ability to create brands. So, you must be using electrol at your home if somebody gets fever or somebody gets malaria or whatever. So, electrol is FDC's brand. Enerza, Ziffy, these are all FDC's brands. So, the company has a history of creating large segment leading brands in our country. And that is basically the core competency that we look at when we are selecting branded generic prices. Coming to the second bucket, which we spoke of, the API CDMO bucket. Now, the API CDMO bucket, essentially what we are seeing is China plus one happening across the world. So, basically 80% of the world's raw material in pharmaceutical today come from China. And the Western countries have basically realized that you cannot depend on China as a single source because China can then weaponize the ability to sell you the raw material of pharmaceuticals. And hence they are looking for an alternate vendor ecosystem. Now, the only other country which can give them the cost, capacity, and capability close to China is India. So, each and every API CDMO company in India, no matter which company you look at, they are all doing capacity expansion because just the amount of order book that they are seeing that they are getting, that order book cannot be serviced with their current capacity. So, they have to increase capacity to cater to their potential customers.
Fair point. Within companies, within the pharma segment, you've talked about brand strength as also, maybe a secular growth, capacity expansion. In terms of financials, what are the 4 or 5 parameters that you're looking at which sets apart a company that you may buy or a stock that you might ignore?
So the financial parameters we look at, there are 4 or 5 parameters. I'll take you through them one by one. One is obviously the secularity of top line growth. How consistently has the company been able to grow over the past decade, right? So if you notice the top line growth of unbranded generic companies, some year they will do 40% top line growth. The next year they will be down 30% because, in a given year they launched a differentiated product and then it later got competitive. So they lost all their market share and pricing, right? That happens in unbranded player. In a branded player, what you will see is they will grow every year. Some year they will grow 5%, some year they'll grow 12%, some year they'll grow 15%. But in no year they will grow 40%, in no year they will have a decline in revenue, right? So the secularity of earning growth, the top line growth is very important to us. Second is the maintenance of margins, both gross and EBITDA margins. So if you have pricing power, that should reflect in the fact that your gross margin will be very less volatile. Your EBITDA margin also will be very less volatile. The third is your ability to convert the profit to cash. So the EBITDA to operating cash flow conversion, that is very important to us. So if you're earning 200 crores of EBITDA, but your cash flow is going to be 20 crores, that EBITDA is of no good use to me, right? Whereas if you're generating 100 crores of EBITDA and out of that 100 crores, 80 crores is getting translated to operating cash flow, that's an asset I want to own, right? The fourth parameter we look at is valuation. So in terms of valuations, we definitely look at EV to operating cash flow as a metric. Now, why EV to operating cash flow? One, EV takes account for debt or net cash, whatever you might have on your balance sheet other than just the market cap. And why operating cash flow? Because operating cash flow includes the impact of working capital on your profitability, which is left out when you look at EBITDA or PAT as a valuation number. So that is why we look at EV to operating cash flow. Last but not the least, one parameter we look at is cash return on cash invested, which is the equivalent of cash ROCE. So we look at return on capital employed, but we look at cash return on capital employed. So there are multiple companies today that might have 200 crores of PAT, but only 20 crores of operating cash flow. But there are companies also which have 50 crores of PAT and 100 crores of operating cash flow. So as the asset manager, I'm only concerned about the cash that the company generates. I'm not concerned about what profit is reporting. So I will look at cash return on cash invested, which is CROCI.
Okay. Mr. Khemka, for the audience, let me just inform them, this is not the only fund that he tracks or manages. Mr. Khemka manages 3 other funds for InCred. Are these 4 valuation parameters that you talk about also the hallmark of 3 other funds, Mr. Khemka?
Yes, that's a part of our operating framework. It is reflected across funds.
Okay, and this is the return that I want shareholders to viewers to please focus on. Look at since inception. This is the extra alpha of 3.6 percentage point that InCred Asset Management has delivered on this healthcare portfolio. 20.3% over the last CAGR over the last 4 years since this concentrated portfolio is in place. Mr. Khemka, one other thought that let me just play the devil's advocate. You have a deep understanding of pharma, and therefore this is something that is intuitive to you. But pharma, like many other sectors, has given lumpy returns. You have a great 10 months and then quiet period. So is this the reason why you've gone after maybe hospitals, maybe diagnostics, where businesses are non-cyclical and predictable?
Yes, Shailesh, you are absolutely right. That's the reason we have gone behind companies like those API CDMO companies, hospitals, diagnostics. These are far more secular businesses than pharmaceuticals are. That's number one. Even within pharmaceuticals, let me inform you, branded generics are not cyclical. Branded generics are not. Why we say as investors, retail investors, that pharma is cyclical? Because we are looking at the unbranded companies, which are the larger companies. Your Sun Pharma, your Reddy, your Cadila, Lupin, Biocon. And those stock prices show lumpiness. Those stock prices show very lumpy returns in a few years and then very poor sort of span of years. But because you are looking at the larger ones, which are all unbranded, you have labeled the entire space as cyclical, which is not fair. So if you look at, say, stock returns of Divi's Labs for the past 20 years, or you look at FDC for the past 22 years, none of them have lumpy returns. They have very secular returns over the past 22 years. And hence, I would argue that pharma is not cyclical. It is certain business models within pharma that tend to be cyclical. And because you look at those names, you think the entire space is cyclical, which is not the case.
No, I understand your thesis. The limited point was that somewhere in 1994 there were 30,000 actually 3 lakh pharma companies in India, and after we signed the WTO as also the GATT, that number was cut down by by a zero. So we came down to 30,000. Now that 30,000 is down to 3,000.
Yes.
And possibility of it coming down to 1,500 is quite high over the next maybe 20 years or so. I understand the thing, but journalists such as us try to give synonyms or thought processes to a particular sector, and that's why I said pharma was cyclical. I understood the logic behind your investments, but I just wanted to sort of flesh it out via you. Now, the future ahead for pharma against the backdrop of China controlling a large chunk of the raw material space, but also a lot of hectic activity happening on the US tariff scene. Does that worry you a bit? Do you spend sleepless nights because of Donald Trump wanting to put 200% tariffs on Indian pharma exports?
Yeah, so two things here. Number one, we as a theory, as a framework, we do not invest in companies that sell to US. Because that market itself has very poor economics even without the tariffs. So if tariffs were to come, God help those companies, I don't know what they're going to do, because anyways they are working on wafer thin margins as we speak, right? Okay. Intensely competitive market, very poor prices already. So I don't know what they will do if tariffs were to be imposed, and hence we don't work on them. Second, let's talk about if tariffs can be imposed on them, even though we don't hold those stocks. We don't hold the branded generic space. So let's say tariffs were to be imposed, would they be imposed on these companies? My answer is fairly unlikely. If you look at the US pharmaceutical market structure, 90% of the US pharmaceutical market by value is patented, but they are only 10% by volume. And 90% of US market by volume is generics, which is only 10% by value. And Indian pharma companies that sell to US sell generics. So it will be very difficult for the US administration to put tariffs on products which are 90% of your volume and only 10% of your value. Why do you want to tariff that product? That is already saving you a lot of money. So I don't know whether they will do it, but even if they did, my portfolio will have no impact because we don't hold any companies that sell into the US.
That's a fairly strong and logical argument of not getting worried about Mr. Trump's tweets as far as your own portfolio is concerned. Mr. Khemka, if I were to press you and ask you for 3 specific bets: one long-term secular hospital story, one long-term secular CDMO/API story, and one long-term secular pharma story that you have in mind, or they may be a part of your this portfolio, or you may be just looking at them. Where do you feel lies value?
Sure. So the first is the long-term hospital bed story. I will stick with Healthcare Global. As you can see, it is the largest position of our portfolio. Why Healthcare Global? It is an oncology super specialty hospital. Now, as you know, oncology implies cancer patients. A cancer patient is a patient for life. Sarish, if a patient comes for maternity to a hospital, he might come for 3-4 days, might give birth to the baby, and may not ever come back to the hospital. But a cancer patient, once he gets admitted to a hospital, he's a lifetime patient. He will keep coming back to the hospital for medication, radiation, IV drugs, as and when needed. So he's a long-term value customer, basically. So that is why, and cancer is one of the fastest growing diseases today in India. One of the fastest. And cancer as a disease has multiple variations and multiple technological advancements every year. So you need a super specialist there to give you the best quality standard, to give you the best, latest tech that is there in the space. And that is exactly where HCG is positioned. That is exactly where extremely bullish on HCG for the next 5 to 10 years, I would say. Right. So that's your top bet on hospital space, simply because it's in an area that is growing and it has a dominant position in the marketplace. There is absolutely no challenges to HCG in the oncology super specialty space. Right. So limited competition, extremely fast growing area, valuation comfort. That's basically what drives our position in HCG. The second you asked for is a
API / CDMO space.
API CDMO space. Right. So in the API CDMO space, we are extremely bullish on Jubilant Pharma. That again, as you can see, is one of our top picks in the portfolio already. Now, Jubilant Pharma, why? Number one, they do radiopharmaceuticals. Radiopharmaceuticals are basically used in diagnostics. Before the patient goes for a scan, he has to take the radiopharmaceutical. Number two, they also have multiple other businesses like allergy. They have businesses in the US where they contract manufacture sterile injectable products. Now, these are segments where, there is again very limited competition, very high return on capital. Customer stickiness is very, very high. And it is the Bhartiya group whom we have known for the past 20 years. They're excellent quality corporate governance group. They're excellent quality executioners. So we have absolutely no doubt that from a 5 or 10 year standpoint, Jubilant can be a fantastic performer for us. Simply because there are multiple businesses and all of them are sort of firing on all cylinders. So that's another, sort of top pick that I have for you. Last but not the least, on the branded generic space you asked.
Yes.
Yeah. So on the branded generic space, our topic today is FDC Limited. As I said, they have brands like Enerzal, Electrol, Ziffy. These are household brands. These are like the Lux and the Doves of the pharmaceutical world, right? You will find them in every household. And FDC, is sort of not such an active management. They don't interact with investors much, but their own doings in the past. So their actions speak louder than their words. So their actions in the past has clearly proven that they have the ability to create large brands in India, which is a very, very difficult task to do. Very few companies, especially pharma companies, have been able to achieve that. And they are one of those guys. And yet they are pretty subscale. They are only about 1100-1200 crores of sales in the Indian market. And that has the potential to grow exponentially in the next 5 to 10 years. As they keep creating more and more newer brands, they keep bringing more variations into their portfolio. So that's one of the, our highest conviction, I would say, branded generics play is FDC.
And the fact that over the last 10 years, FDC has done 5 buybacks, not only reducing equity, but also creating long-term value for those shareholders who are left behind. One final pick from the pharma space, Mr. Khemka, which is not a hospital, not an API CDMO, or not a branded generic company, something that maybe not falling into the 4 or 5 valuation parameters that you have spelt out, but is doing fantastic job.
So I don't think we discussed diagnostics. I think that is when we have Krishna Diagnostics as our topic again. Now Krishna Diagnostics, the stock price has not done that well over the past 2-3 years. They've had several issues in terms of execution, but I think the next 5 years for Krishna is going to be a great time. So Krishna, basically what they do, Sailesh Bhai, is they are a B2G player. So they manage the labs inside government hospitals. Now, as you may know, a majority, 60% of the healthcare infrastructure of our country is operated by the government of this country. But that handles only 10% or less than 10% of the paying population. And now the reason why that happens is because of inefficiencies by which the hospital and the lab is operated when it's owned by the government. right? So that is where Krishna comes in. It's a PPP based model where they basically tell the government that we will manage it professionally for you, and then we'll be able to give you better results, right? So again, high pricing power because there's no competition for Krishna in the B2G space in diagnostics. Very long-term contracts with the government, ability to execute is very, very good. And there's a long runway for growth. So Krishna started with 8 crores of revenue in 2011. Last year they had 600 crores plus revenue. So you can see the growth that they're
Yes.
doing. And that is probably going to continue for the next 5 to 10 years as well.
Right. With this, we'll put in a brief pause as far as the healthcare portfolio of InCred Asset Management is concerned. Just a broad brush, Mr. Khemka, what do you think of the markets at this point of time?
So I think, look, the frontline stocks clearly seem to be a little overvalued to me. The reason why I say that is if you look at Nifty 50, the last 25-year average of Nifty 50, it has been 18-19 times PE multiple with about 13-14% earnings growth. Whereas today what we are looking at Nifty 50, we are looking at 22-23 times PE multiple with earning growth of around 10%. So not only is your earning growth lower, your PE multiple is also higher, which implies your PEG ratio, which historically has been 1.5, is currently around 2.5. Now that tells me that we are in a slightly overbought zone when it comes to the broad market, and hence it makes sense for investors to look at more bottom-up research companies than do passive investing in ETFs or Nifty 50 kind of products.
Okay, fair point. And on the 4 or 5 valuation parameters and the thought process that you just outlined, in the broader portfolios of InCred Asset Management, what would be the top investment idea in terms of money deployed?
So today, in terms of money deployed, our highest amount of capital is deployed in Healthcare Global, HCG.
HCG. Apart from that,
The second name,
non-pharma.
so non-pharma, I think our largest weight today would be in the company called Indus Towers. They do telecommunication
Yes,
towers.
of course.
Yes. So they
So it's a
telecommunication towers. That's right.
huge cash generating company, now a
That is-
subsidiary of Bharti Airtel.
That is correct.
Mr. Khemka, time draws to a close. Unfortunately, we'll have to draw the curtains on this conversation. Thank you for such a wonderful discourse on how you pick stocks and the wealth of information that you shared on your pharma companies and picks. It was a wonderful discussion. Thank you for your time, and I hope that the alpha that you generate for your shareholders now exceeds by leaps and bounds. Have a nice day and a wonderful year ahead.
Thank you, Sailesh bhai.
That, ladies and gentlemen, was Mr. Aditya Khemka. He runs a very concentrated portfolio of healthcare companies, 550 crores invested in 13 companies with 10% cash, and has a preference for small cap companies. About 80% of his picks are small caps. He looks for branded generics. He looks for hospital chains which are still sub 20,000 crores in terms of market capitalization, and of course he looks at companies which have higher pricing power and a secular consistent growth in sales and profit. Thank you for your time. Thank you for watching us. Please continue with Business Way Television. There's a lot that's happening on the other side.
If you like the video, do like, comment, share and subscribe.